The dollar on Thursday last week posted its biggest daily fall of 1.7% since November 2022. That's after President Donald Trump imposed tariffs on imports at levels not seen since the early 1900s. For decades a safe bet, investors who'd normally rush to the dollar ran away from it instead. They say it's a sign that the greenback's global standing may be eroding. But is this the case? Some investors and analysts say Trump's administration has been chipping away at the dollar's appeal.
We will impose a 25% tariff on all foreign-made automobiles.
They argue it's due to Washington's protectionist policies, to the upending of global economic order, and a growing US debt pile. Left unchecked, investors say, this lack of confidence in the dollar could undermine its position as the world's reserve currency. If the dollar falls, it could result in higher interest rates for longer. That's because price pressures at home could make it harder for the Federal Reserve to cut rates. Simultaneously, a rapid strengthening of currencies against the dollar is a headache for other central banks navigating a weaker economic outlook. It makes their exports more expensive and potentially harder for them to revive growth. Despite such growing worries, the dollar is still firmly positioned as the world's top reserve currency. Trump has said he wants it to maintain that status and warned against attempts to undermine it. The currency also has an inherent competitive advantage. It's backed by the world's largest economy, the deepest capital markets, and an established rule of law. In the near term, there's no real alternative.
European shares rose from 14-month lows on Tuesday. It gave investors some relief after 4 straight sessions of heavy selling, although their mood was still sensitive to tariff-related developments. The Pan-European Stock 600 was up over 1%. It previously shed 12.1% in the past 4 sessions as investors worried about a possible global recession. As of Monday's close, the index declined almost 18% from its all-time high hit in early March. Germany's benchmark also went up over 1% after the index stopped short of confirming a bear market in the previous session. Investors piled into defence shares after a large sell-off Monday and lifted the index over 3%. The shares of lenders also rose. One leading analyst warned this might just be a temporary bounce rather than a full recovery. They said the fundamentals which caused the sell-off haven't changed as of yet. The trade war ignited by President Donald Trump's tariffs showed little sign of slowing down either. China refused to bow to what it called blackmail from the US, while the European Commission also proposed counter-tariffs of 25% on a range of US goods on Monday. Shares of India's Tata Motors sank 10% on Monday before recovering some ground. Tata's luxury car unit Jaguar Land Rover paused exports of its British-made cars to the US after President Donald Trump's 25% tariff came into effect. Industry data shows the US is the second biggest importer of British-made cars after the European Union, with nearly a 20% share. The US was one of JLR's only growth markets last year, and it makes up more than a quarter of its global sales of Range Rover Sports, Defenders and other models. JLR's sales account for 2/3 of Tata's revenue and a big part of its profit and cash flow. That's made Tata one of the biggest losers among auto stocks since the tariffs were announced. Its slide has been more than double the roughly 10% drop in the broader auto index. Monday's slide has dragged the stock's overall fall to 22% since Trump announced import duties in late March.
What if AI could give us a leg up on where wildfires may erupt around the globe? A European Climate Research Institute is trying to find a way to do it. Their new AI-driven model goes further than predicting how likely a fire may be, to look at where in particular it may break out.
It's quite a large leap forward, I think, in terms of fire forecasting.
Historically, fire forecasts rely on 4 weather variables: temperature, wind, precipitation, and humidity. But climate scientist Dr. Joe McNorton at the European Centre for Medium Range Weather Forecasts, or ECMWF, says that model has its limitations.
It doesn't account for fuel, it doesn't account for ignition sources and things like that.
The Institute has a new probability of fire model, which uses machine learning methods to analyze a wider set of data. It incorporates fuel and sources of fire ignition into the analysis for more precise predictions of where fires might start.
So I think the machine learning really helps with getting the more precision on the location of where a fire might occur. And this is relevant for agencies involved in suppression activities because then they can allocate resources into the locations where the fire might actually occur as opposed to just a widespread warning system that currently exists.
Devastating wildfires in Los Angeles in January killed 28 people and damaged or destroyed nearly 16,000 structures. Unusual wet weather conditions leading up to the fires led to ample vegetation or fuel, then made flammable by exceptionally dry weather at the start of winter.
Yeah, for example, recent case in Los Angeles.
ECMWF's principal scientist, Dr. Francesca Di Giuseppe, says the new model considered that fuel abundance.
Our prediction in this case was much more precise and pinpointed the exact location when very close to Los Angeles where fire really occurred.
Last year, wildfires forced the displacement of 800,000 people, the highest since records began in 2008. McNorton hopes that fire prevention agencies around the globe will soon use their model to mitigate that damage without breaking the bank.
So the purpose here is to try and produce a cost-effective piece of machinery that people can take away and use. So it's very expensive maybe to train, but once we've trained the model here using our high processing computing power, other centres can then take it and run it very cheaply, and they can run it on their local laptops, for example, with very little cost.
Samsung Electronics is set to beat forecasts, possibly with a little unintended help from Donald Trump's tariffs. The South Korean tech giant said Tuesday that operating profit would hit almost $4.5 billion for the January to March quarter. That's well above estimates by analysts, who had predicted a big drop. One factor may have been buyers rushing to beat the imposition of a 25% levy on exports to the US, due to kick in from Wednesday. Though memory chip prices dipped over the period, one analyst told Reuters that it looked like volumes had been boosted by customers trying to stock up. It may have been a similar story for smartphones, with signs that US retailers put in big orders ahead of the tariffs. Now analysts say Samsung could see a corresponding dip in sales over the coming months if customers really have stocked up. The company also faces questions over its AI chips. Samsung has struggled to supply US champion Nvidia with high-end silicon. It has also warned of a hit from Washington's restrictions on sales to China, its biggest market. Earlier in the year, Samsung executives were forced to apologize over the firm's struggles in the AI market, where it's been lagging local rival SK Hynix. On Tuesday, the focus was on the better-than-expected earnings forecast, though. Samsung shares were up around 1% by early afternoon following the figures. The company will now release detailed earnings at the end of the month.